When you ask ChatGPT a question, somewhere a GPU processes your prompt. That GPU sits in a data center. That data center was built with borrowed money. The bond that funded it has a maturity date. The GPU has a depreciation schedule. One of those timelines is about to collide with the other. I've spent 10 years watching capital pathways in Chinese markets. The last few episodes we traced the disconnects. Exit pathways, valuation gaps, licensing bottlenecks, deployment shortfalls. Now the question shifts. What's being built, and with whose money? This episode is about a structural change in AI finance that most coverage misses. The money building AI infrastructure is no longer coming from venture capital. It's coming from the bond market. Investment-grade bonds, junk bonds, GPU collateralized debt, a new asset class backed by silicon that loses value every quarter. Let me show you what I see. Start with the Capex number, because it sets the scale for everything that follows. The four largest U.S. cloud vendors have guided roughly $725 billion in combined capital expenditure for 2026. Amazon at approximately $200 billion. Microsoft at approximately $190 billion. Alphabet at approximately $185 to $190 billion. Meta at approximately $125 to $145 billion. That is a 77% increase from 2025. Now the revenue side. Credit research firm CreditSights estimated that AI Capex will absorb approximately 94% of these companies' operating cash flow in 2026. For comparison, in 2023, the year generative AI broke out, Capex consumed roughly 40% of operating cash flow. 3 years, the free cash flow cushion went from 60% to 6%. When operating cash can't cover Capex, companies borrow. In Q1 2026 alone, the top hyperscalers issued approximately $136 billion in new bonds. That figure already exceeds the $121 billion issued in all of 2025. For context, from 2020 to 2024, annual average bond issuance by these companies was roughly $28 billion. We went from $28 billion a year to $136 billion in a quarter. Morgan Stanley projects AI-related global debt issuance will reach approximately $570 billion in 2026. That includes investment-grade bonds from the hyperscalers, plus a new category, GPU collateralized debt from companies like CoreWeave. And there's more beneath the surface. Morgan Stanley estimates total off-balance sheet commitments for data centers and power contracts at approximately $1.8 trillion. That breaks down into roughly $982 billion in purchase commitments, $822 billion in unexecuted leases, and $110 billion in payables. Not on the balance sheet, not captured in the debt figures, but real obligations that will consume cash for decades. $725 billion in Capex. 94% of operating cash flow consumed. $570 billion in bonds. $1.8 trillion in off-balance sheet commitments. The AI infrastructure build-out is being financed by debt at a scale that has no precedent in technology. CoreWeave is the clearest signal. This company went from $4.9 billion in total debt to $17.3 billion in 12 months. A 3.5x increase. It raised an $8.5 billion term loan backed by GPU hardware and customer contracts. Moody's gave it an A3 investment grade rating. Another $3.75 billion in junk bonds at roughly 9% yield. Nvidia invested $2 billion directly. The revenue backlog stands at $99.4 billion as of Q1 2026. What makes this different from a normal corporate bond? The collateral is GPU hardware, silicon chips that become obsolete. No real estate, no diversified cash flows, just hardware on a timer. Goldman Sachs modeled the difference between a 3-year GPU replacement cycle and a 7-year cycle. The gap is $1.76 trillion in depreciation. When Nvidia ships its next generation of chips, the GPUs backing these bonds don't just become less competitive, they lose collateral value. Every GPU-backed bond reprices. Every time a new asset class gets packaged into bonds this fast, the repricing starts in the collateral and works its way up the chain. The mechanism is consistent across cycles. The collateral changes. GPUs are not houses, and the AI revolution is real. But the financing structure has created a new kind of credit risk that most investors are not tracking, because it lives in the bond market, not the stock market. Now let me show you what the AI infrastructure build-out looks like on the other side. China is reportedly planning a national AI data center grid, with reported investment estimates varying widely depending on the source. The plan relies heavily on domestic chips from suppliers like Huawei. That's the state-backed side. On the venture side, a new category of company has emerged in the past 18 months. They call themselves AI infrastructure companies or token factories. Their business: take raw compute, optimize it, and sell standardized token output to model companies and enterprises. 3 stand out. First, InfiniAI. Founded at Tsinghua's Electronic Engineering Department, cumulative financing exceeds RMB 2.2 billion, with a Series B round of over RMB 700 million in May 2026. Their agentic MaaS platform runs 160+ models. They position themselves as a supergrid for heterogeneous compute, scheduling chips from multiple vendors into a unified token supply. The CEO has said profitability is 3 to 5 years away. Second, SiliconFlow. Founded by Yuan Jinghui, who previously built the OneFlow deep learning framework. Over 6 million users, thousands of enterprise clients. Daily token generation in the hundreds of billions. Supports Nvidia, AMD, and domestic chips, still operating at a loss. The price war from cloud giants compresses margins further every quarter. Third, Magic Cloud. Founded in June 2024 by Xu Lingjie, former president of Biren Technology and previously director of AI infrastructure at Alibaba Cloud. Pre-A round of several hundred million RMB led by Datai Capital. Their concept, the token superfactory. Industrialized, standardized token production. Token cost structure is approximately 80% server procurement. They don't make their own chips. They optimize the hell out of other people's chips. And then there's Gflow. Just filed for a Hong Kong IPO after 3 years. 11 funding rounds in 36 months. Valuation went from RMB 29.4 million to RMB 9.16 billion. That's a 311x increase. Debt to asset ratio, 136.61%. Operating cash flow, negative every year since founding. 84% of revenue comes from hardware integration with 16.8% gross margin. The high-margin services business is only 16% of revenue. Their prospectus calls them China's largest independent AI compute cluster provider. I'm not making a judgment on any of these companies. I'm pointing out a pattern. The AI infrastructure sector in China is producing companies that scale on venture capital and debt before the revenue model is proven. Gflow's 311x valuation expansion in 3 years with negative cash flow and 136% debt ratio is not an outlier. It's a feature of the current cycle. Capital running ahead of revenue. Revenue model unproven. The repricing risk lives in the venture portfolio. Let me pull this together with the framework we've been building across this series. Every asset class has a capital pathway. The pathway runs through different instruments at different stages. Early stage, venture capital. Growth stage, growth equity and strategic investment. Maturity, debt markets and public equity. AI infrastructure has jumped straight from venture capital to bond markets. It skipped the middle. The build-out is happening so fast that companies can't wait for revenue to fund expansion. They borrow against future demand. This creates a position problem. In the debt chain for AI infrastructure, there are 4 positions. Position 1. The hyperscalers issuing investment-grade bonds. Amazon, Microsoft, Google, their balance sheets can absorb the risk, diversified revenue. If AI Capex doesn't generate returns fast enough, they slow down. Painful, but survivable. Position 2. The GPU-backed debt issuers. CoreWeave, the neocloud companies. Their bonds are rated A3 by Moody's based on revenue backlogs from Microsoft and Meta. But those backlogs assume the GPUs stay relevant. When Nvidia ships Rubin or whatever comes after Blackwell, the collateral reprices. Position 3. The token factories. InfiniAI, SiliconFlow, Magic Cloud, Gflow. They are still in the venture phase, but their cost structure is 80% hardware. They are spending like they have bond market access, but they have venture timelines. If the token price war continues, the path to profitability keeps moving out. Position 4. The end buyers of the debt. Pension funds, insurance companies, European investors now buying into CoreWeave's euro-denominated bonds. They are one step removed from the underlying asset. They hold paper that is backed by hardware they can't inspect and customers they can't monitor. Position decides return. Where you sit in the capital pathway determines how much repricing risk you carry when the GPU cycle turns. 3 questions I track when I look at AI infrastructure investments. Whether it's a bond, a VC round, or an IPO filing. 1. What percentage of the funding is debt versus equity? If a company's debt-to-asset ratio exceeds 100% and operating cash flow is negative, the capital pathway is already under strain. Gflow at 136% is a data point, not a verdict, but it's a data point I wouldn't ignore. 2. What is the GPU replacement assumption? If the business model assumes a 5-year or 7-year GPU useful life, ask what happens at year 3. Goldman's model says the difference is $1.76 trillion globally. Where domestic chips are still behind on performance, the replacement pressure may actually be lower in the short term. But the cost efficiency gap creates a different problem. More chips needed for the same output. That's a margin problem, not a collateral problem. Both are real. 3. Who holds the debt? And can they absorb a 20% collateral haircut? If the answer is pension funds buying GPU-backed bonds at par, the systemic risk is different from if it's a strategic investor who can ride out the cycle. Position in the debt chain carries as much weight as position in the value chain.
The demand for compute is real. The infrastructure is being built for a reason. But the financing structure has created a new layer of credit risk that didn't exist 2 years ago. I'm watching from where the repricing starts. Next time, we move from the financial layer to the application layer. Anthropic just released the cloud for financial service. Goldman Sachs embodied the Anthropic energy on-site for 6 months. Fact-size stock dropped 8% the day it was announced. The orchestration layer for financial data is being rebuilt. I will show you what that means for how Wall Street price information. I will see you next time.